네, 월가 트레이더 버니의 미국 주식 시간으로 돌아왔습니다. 앞서서 시황센터를 통해 간밤에 뉴욕증시 상황까지 좀 짚어봤는데요. 주식 그리고 코인 할 것 없이 대부분의 자산들이 좀 하락하고 있는 상황입니다. 이러한 상황에서 미국 시카고의 재무 컨설턴트로 계신 버니 씨와 화상 연결을 해서 준비한 내용 들어보도록 할 텐데요. 이야기를 좀 어떤 이야기를 하실지 체크를 좀 해보면 최근 시장이 또 변동성 장세가 계속해서 유지가 됐는데 그 아래에서 하방으로 방향성을 좀 튼 모습이죠. 그 안에서 금리 인상 이후에 현재 상황이 어떻게 진행되고 있는지 자세히 진단해 주신다고 합니다. 해당 내용 지금 바로 만나보시죠.
Let's briefly review the market right now and talk about how things are setting up now that we've had our second rate hike. So this chart we've shown before, and what these bottom three lines are the number of stocks that are down. So at the bottom of a market, we should have a higher portion of the number of stocks down, a higher percentage. And we can see that we're not down as far here as we were before as the market started to roll over. And we talked about the fact that we needed to get more of these stocks up to get a double bottom to be able to buy the market. Now let's think about four separate little tables to be able to identify and where we are in perspective of how this year has gone so far and what we think going forward. So if we look at here in this chart, we know that these are all the bad 4 months, the worst 4 months that we've had in terms of the years. So 1932, 1939, all the way down. And you can see that 2022 is the third worst first 4 months of a year. But when we look at what happens the rest of the year, very rarely do we decline much from here. Now, our sample size is only about 10 or 11 years, but we've never been down this much in the first 4 months over that period of time. So my contention is that we probably, just thinking about this in and of itself, without any other things thinking about, we may be to a point now where the market should slowly start to base and start to bottom and roll higher. Now, we also want to look at, now we're in our second rate hike, okay? We've had our second rate hike, and we think we're going to a 2% to a 3% funds rate. Whether we get there or not and how we get there or not, I think are going to have a lot of other things to play. Whether we're in a recession, do we go to 2 to 3%? Do we slow down? Do we pause? I believe that the Fed, once they see negative economic growth continuing on and somehow we don't have employment growth, they're going to slow down. So now I'm not predicting we're going to get there, but there's just so many variables to take into consideration. When we look here, though, what we can see is there's been all these occurrences where the Fed was on a prolonged period of increasing the federal funds rate. And what we see is that a lot of times we don't go lower. Now, when we annualize this, so if you look at the top line, 1946 to 1953, that's a long period of time that they were doing it. We were up 40% during that period, but when we annualize it, we only annualized it at 7%. But the point is that we have better odds of continuing to go higher once these rate hikes have started. And the rate hike started in March, mid-March, March 16th of this year. The next thing we want to think about is this a bear market? Is there a recession? Is there not a recession? Okay, right now we've had 1 quarter of negative growth. Whether we're in a bear market or not, we have to go down 20% to truly qualify as a bear market. We're down about 14% right now. So whether we get down whether we go down 20% or not, there have been 17 bear markets. 13 of those 17 had a recession attached to it. So if we don't get a recession, we'll be one of these 4 bear markets that didn't have a recession. So whether we go down 20 or not, if we go down 20, the odds are that we'll have a bear market, but it's not that we'll have a recession, but it's not a complete certainty that we'll have a recession. And we can have a period of slow growth and then do better. Finally, we want to look at all the corrections that we've had, okay, and what do they look like? So going back again to World War II and farther and all the way current, we want to see, these are all in chronological order. We're obviously the bottom one, 13.9% through April 29th, which is the end of April. It's about an average setback so far. Average number of days, 117 versus the average of 133. Not that far off. Some of these go longer, without a doubt. Some of them don't. But so far, we've chewed through the average of a typical decline. What we've done this time is we've impacted the high growth stocks so significantly. So many of those are down 70%. So just because we're in an S&P 500 average decline, the average stock X the S&P 500 is down significantly from there. So maybe that's another reason to think that we're probably about as far as we may want to go now. We still have to think about other things, and all we're trying to do is put this into perspective. Warren Buffett, smart man. He's had a tremendous track record going back 50 years. What did he do? Well, he purchased $52 billion worth of securities in the first quarter of this year. Of those $52 billion, $41 billion was purchased between February 21st and March 15th. All right here. So he bought 80% of his stocks, and he purchased a lot of stocks in this first quarter. 52 billion. He bought 80% of those down right at the bottom. Warren Buffett's constant mantra is, when everybody wants to sell is the best time to buy. So he's able to purchase, and he's done this so many times in the past, he's able to accumulate high quality stocks and great quantities of high quality stocks at a period of severe distress in prices. He bought Salomon Brothers when Salomon Brothers had a terrible problem. He bought Goldman Sachs in 2008 when Goldman Sachs had a terrible problem. He's able to purchase high quality names because he waits for prices like this to be able to purchase. He lagged the market last year, but now he's accumulating again in a fairly significant amount. Now, my contention always has been we want to see a high number of stocks below their 200, their 50-day moving averages, so it's a pervasive market. We want to see terrible levels of investor sentiment to be able to identify a bottom. And we want to see poor liquidity. Poor liquidity means there's very few bids and offers on the market. So when we take a look at what's gone on here, we can see that at the bottom of the market in March of 2020, when COVID was at its most dire impact into the market, we had terrible levels of liquidity. When we got back here in late January and early March, we had really poor levels of liquidity, which told me this is the time that the market's probably not going to be able to go down a lot more. We've had everybody distressed, they're selling at the wrong prices, and we start to go up. And then over the course of the last few weeks, I've talked about the fact that we need to see that illiquidity hit to be able to time the bottom and identify a bottom where we can rally 7 to 8%, because we rallied 7% off that last low, and to be able to, and we did that in 2.5 weeks. we haven't gone down yet low enough to be able to identify this bottom. This just goes back to January of 20. Let's look further back on that, and we can see now that we're not down at levels, I think, to identify that we have enough loss of liquidity to be able to identify a bottom. But I think for a tradable bottom, we're really close.